Welcome back to the deep dive. So I want to start today with a little trip back to high school physics class. Do you remember Sir Isaac Newton?
Vaguely,
Yeah.
yeah. I remember the apple flying on his head, something about gravity, right?
Exactly. But today I'm thinking about his first law of motion, the law of inertia.
Okay.
It basically says that an object in motion tends to stay in motion.
Right, with the same speed and direction unless something, stops it.
Precisely. The classic example is the hockey puck on ice. There's almost no friction, so you give it a push and it just keeps going.
It doesn't need a motor. It just has that initial inertia.
Right. So here's the big question that's going to drive our entire conversation today. Does that law of physics apply to your money, specifically to the stock market? If a stock is going up, if it's in motion, does the simple fact that it's already moving up mean it's, I don't know, scientifically more likely to keep going up?
It's such a fascinating question because, traditional financial theory, the stuff they teach you in business school, the efficient market hypothesis,
Right.
it says absolutely not. It says the exact opposite.
Past performance is not an indicator of future results.
Exactly. It says all known information is already in the price. So if the stock is up, it's just more expensive now. But the data we're looking at today suggests that maybe Newton was a better investor than the economists.
And that brings us perfectly to the news of the day. Today is Wednesday, February 18, 2026. And right now, as we speak, one of India's biggest financial players, SBI Mutual Fund, is making a huge bet on this exact principle.
They are indeed. And it's a big deal because, SBI is generally seen as the big conservative giant. Right?
So a safe option.
Yeah. So for them to step into this arena, that's a signal.
They've just opened a new fund offer, an NFO, for this, and get ready for this, the SBI Nifty Midcap 150 Momentum 50 ETF.
That is a mouthful.
It is. It sounds like a secret code or like a really secure Wi-Fi password.
It does, doesn't it? But to be fair, every single one of those words is doing a lot of heavy lifting. It tells you exactly what it is you're buying.
True. And our mission today is to crack that code. Because momentum investing, it just sounds like a buzzword, doesn't it?
It does, or worse.
Or worse, yeah. It sounds like reckless gambling, just chasing hot stocks. Oh, that one doubled. Let me buy it now.
Right at the top.
It feels like the opposite of smart investing, which we're always told is about buying low and selling high.
This is the classic buy high, sell higher philosophy. And you're right, it feels totally counterintuitive to the value investing advice we've all grown up with. We're told to be contrarians, to buy when there's blood in the streets. Momentum investing says, no, follow the herd, but make sure you're following the smart herd.
So is this index a magic formula for wealth? Or is it, as the documents say, a very high-risk roller coaster that's going to make you sick?
That's what we have to figure out.
We have a huge stack of sources today. We've got the white papers on the index methodology, the official fact sheets from the SBI launch, performance data from the Tata Fund, which has been doing this for a while,
Which is a great proxy.
and some really interesting behavioral finance theories that explain why this might even work in the first place.
Yeah, we're going to peel back the layers. We're not just reading the marketing brochure today. We're looking at the actual algorithm, the machine underneath. You have to understand the machine before you decide if you want to get in and drive.
Okay, so here's the roadmap for you listening. First, we're going to look at the machine itself. How does this thing work? How does it pick 50 stocks out of 150 without a human fund manager?
The rules.
Second, we'll dive into what our sources are calling the power of two. This idea that combining mid-caps with momentum is this potent, almost explosive mix.
The synergy.
Third, we'll get into the nitty-gritty of the SBI launch that's happening right now, the dates, the costs, the structure. And finally, and this is maybe the most important part, we have to do a reality check. We'll talk about the returns, which are frankly eye-popping, but we also have to talk about the volatility and something you mentioned earlier, the churn problem.
The churn is a huge, huge factor. It's the silent killer of returns in strategies like this. People just don't see it on the surface. We absolutely need to spend some time there.
Okay, let's do it. Let's unpack this thing. Part one, the engine. The Nifty Midcap 150 Momentum 50. Before we even touch momentum, we have to define the playground. What exactly is the Nifty Midcap 150?
So if you imagine the Indian stock market as a sort of pyramid.
Okay.
At the very top, the peak, you have your Nifty 50 or the Nifty 100. These are the large caps.
Your Reliance, TCS, HDFC Bank. The giants.
The giants. They're stable, they're huge, but they're kind of like cruise ships. It takes a lot of energy and time to turn them or to make them go twice as fast.
Right. Reliance isn't going to double its revenue in the next 6 months. It's just physically impossible at that scale.
Exactly. Now, at the bottom of that pyramid, you have the small caps. Thousands of tiny companies, huge growth potential, sure, but also a very high mortality rate.
Some just go to zero.
They do. They're fragile. They can get wiped out by one bad quarter or a new regulation.
So the midcaps are the Goldilocks zone.
That's exactly it. In terms of the official NSC ranking, the Nifty Midcap 150 represents the companies ranked from 101 to 250 by market capitalization.
So they're not small companies. I think the word mid can be misleading.
Not at all. I mean, we're talking about companies worth, 20, 30, 50,000 cores. These are established businesses.
They've survived the startup phase.
They've got proven business models. But, and this is the key difference from the large caps, they still have what the analysts call operational runway.
Runway for growth.
Yeah. They can still realistically double their market share. They can expand into new states or new countries without immediately hitting a ceiling.
Our sources call them the growth engine of the Indian economy.
And that's a fair characterization. If the large caps provide stability, the mid caps provide the growth. But, and this is a really big but, the mid-cap universe is messy.
Messy how?
Variance, or dispersion. That's the fancy finance word for it.
Okay.
In the Nifty 50, most of the stocks kind of move together with the broad economy. If GDP is up, the banks and tech companies are usually up.
They're correlated.
Very. In the mid-cap 150, you could have one company that's skyrocketing because it invented some new battery technology, and another company in the exact same index that's crashing because of a governance scandal or a terrible acquisition. The gap between the winners and the losers is just vast.
And that, I'm guessing, is where the Momentum 50 part comes in. This isn't about buying all 150 and hoping for the best.
No. This is a sniper approach. You're trying to pick just the top 50.
And this is the crucial part for you listening. This is a passive, rules-based strategy.
100%.
Meaning, there isn't some guy named Viral at SBI sitting in a room, drinking coffee, reading annual reports, and thinking, I like this company's CEO, let's buy it.
No. Viral Chodva is listed as the fund manager, and he's very capable, but his job here is about execution. It's about making sure the fund tracks the index perfectly. He doesn't get to pick the stocks.
The algorithm is the boss.
The index methodology is the boss.
Yeah.
The algorithm makes all the calls.
Okay, so let's look at that algorithm, the selection process. How do we get from 150 stocks down to 50? My first instinct is we'll just pick the ones that went up the most in the last year. Isn't that what momentum is?
You could do that. That's a strategy called absolute momentum, but it's also really dangerous.
How so?
That's how you end up buying bubbles right before they burst. You end up holding a stock that spiked for 1 week because of some crazy rumor and then crashed right back down. The index uses something much more sophisticated. It's called a normalized momentum score.
That sounds fancy. Normalized. Break that down for us. What does that actually mean?
It's the secret sauce. So instead of just looking at one time frame, it looks at price performance over 2 specific periods, 6 months and 12 months.
Okay. Why those 2 windows? Why not 1 month or, say, 5 years?
It's about capturing the medium-term trend. 1 month is just noise. It could be anything. A celebrity tweeted about the stock. A competitor had a fire,
Random events.
Exactly. And 5 years, well, that's history. That's more like value investing. That tells you about the long-term quality of a business. This 6 to 12-month window is the sweet spot where research shows these trends tend to persist.
It's long enough to be a real trend, but short enough that it still has some juice left in it.
You got it. But here's the genius part you mentioned earlier from the sources. It's not just the return, it adjusts for volatility.
Yes, this is the normalized part.
It is. Let's use an analogy. Imagine 2 sprinters are running a race.
Okay, picturing it.
Sprinter A runs a steady, powerful, consistent pace. Every second they're gaining ground. It's smooth, it's rhythmic. If you drew a graph of their progress, it would be a nice straight line going up.
Okay, that's the reliable one.
Yeah, Sprinter B is erratic. They sprint like a maniac for 10 seconds, then they trip and fall, then they roll on the ground for a bit, then they get up and sprint again like crazy.
That sounds exhausting to watch.
It is. Now, here's the thing. Imagine they both cross the finish line at the exact same time. Their total return or their total time is identical.
So on paper, they're equal.
Right. But who would you bet on to win the next race?
The steady one. Sprinter A. Less drama. I feel like Sprinter B just got lucky or is about to pull a hamstring.
Exactly. And that is precisely what the normalized score does. It takes the return, how fast the stock ran, and it divides it by the standard deviation of its return.
Which is the wobble.
It's the wobble. It's how much it jumped up and down along the way. It heavily penalizes volatility.
So a stock that went up 100%, but did it by swinging 20% up and down every single day,
It gets a lower score.
than a stock that just went up 80% in a smooth, steady, straight line.
Correct. So it's not just highest return, it's smoothest high return. We're looking for strength, not just noise.
That is a really critical distinction.
It is. The algorithm calculates this score, it's technically a Z-score,
Yeah.
for every single one of the 150 mid-cap stocks. It combines the 6-month and 12-month scores, ranks them, and the top 50 make the cut.
Okay, so now we have our team of 50. How do we decide how much money to put into each one? Is it an equal weight thing where they all get 2%? Or is it like the Nifty 50 where the biggest company gets the most weight?
It's neither of those, actually. It uses a mechanism called tilt weighting.
Tilt-weighted. I haven't heard that term as much.
It's a bit of a smart beta thing.
Yeah.
So most standard indices, like you said, use market cap weighting. The bigger the company, the bigger its slice of the pie.
Simple. Passive.
Right. This index does something different. It takes the company's free float market cap
Mm-hmm.
and it multiplies it by that normalized momentum score.
Oh, that's interesting. So it's like a booster.
It's a massive booster for the winners. It tilts the portfolio heavily toward the stocks with the strongest momentum scores. So if you have a relatively smaller company, but it has an incredible smooth momentum score, it can actually get a bigger weight than a much larger company that has a mediocre wobbly score.
So it's doubling down on the strategy's conviction. It's essentially saying, we believe in the momentum signal more than we believe in the absolute size of the company.
Perfectly put. But there are guardrails. There are constraints.
Right.
There's a 5% cap per stock.
Why is that important? I mean, if momentum is so great, why not let a super winner run to 20% of the fund?
To prevent what you could call a supernova situation, you just don't want one massive winner to become 20 or 30% of your entire portfolio. Because if that one stock eventually turns, and all momentum stocks do turn eventually, it would sink the whole ship.
It's a diversification rule.
It's a risk management rule. It ensures that no single stock can blow up the fund.
And this list of 50 stocks isn't permanent. This is not a buy and hold forever kind of thing.
Oh, far from it. This index is ruthless. It rebalances semi-annually
Okay, when?
in June and December. So twice a year, the algorithm wakes up, it looks at all the fresh data for the last 6 and 12 months, and it just says, you're out, you're in.
It's like a constant performance review.
It creates a survival of the fittest environment. If a stock stops moving, if its momentum fades, or if it just starts getting too wobbly, it gets cut from the team. And if a new stock enters the mid-cap space and starts shooting the lights out with a smooth trend, it gets added.
It keeps the mass in motion, as the sources say. It's automating the discipline of selling your losers and holding on to your winners.
Which, if we're being honest, is the single hardest thing for a human investor to do.
We fall in love with those stocks.
We do. We get emotionally attached. We say, oh, it went down 30%, but I really like their product. I'll just hold on. It'll come back.
The algorithm doesn't care about the product.
The algorithm has no feelings. If the score drops below the cutoff, the stock is gone. End of story.
The algorithm has no feelings. That would be a great t-shirt for a finance conference.
I really would.
So that's the how. That's the machine. But I want to get into the why. Why does this even work? Because, like you said, traditional economics says this shouldn't be possible. If the market knows a stock is good, its price should jump up instantly and then the opportunity is gone.
Right.
So why do these trends persist for 6 to 12 months? Why is there enough time for a fund like this to hop on the train after it's already left the station?
This is where we have to leave the world of physics and enter the world of psychology. We have to talk about behavioral finance.
My favorite topic.
Yeah.
The study of why we are all so irrational with our money.
Exactly. The momentum strategy at its core is basically systematizing and exploiting two very specific human flaws. The first one is called underreaction.
Underreaction.
So imagine a mid-cap company, let's call it Deep Dive Pharma. They release a quarterly earnings report, and it's a blowout. Profits have doubled. A perfectly rational market, a computer, would see that news and instantly reprice the stock 50% higher. Boom. Done. The value is reflected.
No time to get in.
But humans, we don't work that way. Investors are skeptical. They think, well, maybe it was a one-off. Maybe they cooked the books. The economy might crash next month. I don't really trust the CEO.
So the good news is out, but the price only goes up a little bit, maybe 5 or 10%.
Exactly. The stock is now technically undervalued relative to the new information because people are hesitant. It takes time for the professional analysts to update their spreadsheets and raise their price targets. It takes time for the big institutional investment committees to meet and approve a buy order.
And while all that human delay is happening, the price is just slowly, steadily grinding higher.
And that leads directly to the second flaw that momentum exploits: herding. Or you could call it the catch-up phase.
This is FOMO, the fear of missing out.
This is pure FOMO. As the price keeps rising and the good news becomes undeniable, all those skeptics slowly turn into believers. The herd arrives.
Everyone wants in.
All the mutual funds that were slow, the retail investors who read about it in the news, the foreign institutions, they'll start piling in, afraid to miss the train.
And all that buying pressure just pushes the price even higher.
It creates a self-fulfilling prophecy, a feedback loop. Higher prices attract more buyers, which in turn creates even higher prices. And this whole cycle typically lasts for that 6 to 12-month window that the index is designed to capture.
So in a way, if you invest in this SBI ETF, you're not really betting on the companies themselves. You're betting on the fact that other investors will be slow to react and then eventually they'll overreact.
You're profiting from human nature. Momentum strategies are built on the fundamental belief that the market is not efficient because humans are emotional creatures, not calculators.
That's a really powerful concept. Now, our outline mentioned something called the power of two. What is that referring to?
It's the synergy. It's the synergy between the asset class midcaps and the investment strategy momentum.
Like peanut butter and jelly.
Or maybe more like gasoline in a match. It can be explosive. Midcaps, as we already discussed, are the most dynamic part of the market. They have the highest growth potential. But they also have that junk problem. A lot of the 150 midcaps are, well, they're duds, they're value traps, or companies in a slow decline, or businesses that just tread water for a decade.
You have to sift through them.
Right. And momentum acts as the perfect filter. It solves the midcap problem. By applying this volatility-adjusted momentum filter, you are, in theory, systematically cutting out all the dead weight.
You're not holding the midcap that's been flat for 3 years.
No, you're only holding the ones that the market itself, through price action, has identified as the current winners.
So you get the high growth potential of the midcap space, but you use this momentum algorithm to curate the list and hopefully avoid the landmines.
That's the idea. It ruthlessly cuts the losers and rides the winners. It's a strategy that's very difficult for a human to execute because we get attached, but the synergy seems to be real. The data shows momentum works in large caps, but the effect is smaller because they're so heavily researched.
And in small caps.
It works there too, but the trading costs, the impact costs, can just eat you alive. Midcaps seem to be the sweet spot where the effect is strong and it's still possible to implement it efficiently.
Okay, that makes sense. Let's pivot to the immediate opportunity here, the news peg. We're talking about this brand new SBI Nifty Midcap 150 Momentum 50 ETF.
Which is live right now as we're recording this.
The NFO, the new fund offer, it opened on February 17th, 2026, and it closes on February 24th, 2026. So if you're listening to this the week it drops, that window is active.
It's a short window, which is pretty typical for these NFOs.
And the entry barrier is low. The minimum investment is just $5,000, and the offer price is set at roughly €10 per unit.
Yeah, that's standard for a new fund launch. They like to start with a nice round number.
Now, it's an ETF and exchange-traded fund. We should probably clarify how that's different from a regular mutual fund, because I think a lot of people get those confused.
Sure, so a regular index fund, you buy and sell it at the end of the day. You place your order and you get whatever the NAV, the net asset value, is calculated to be after the market closes at 3.3.
One price per day.
One price per day. An ETF, on the other hand, trades all day long, just like a stock. You can buy it at 10:00 a.m. and sell it at 11:55 a.m. if you want to. And to do that, you need a demon account.
So it gives you intraday liquidity.
It does. You can see the price moving in real time. If there's a huge market crash at 1 p.m., you could theoretically sell your ETF units at 1:05 p.m. With a mutual fund, you're stuck waiting until the end of the day, and you'll get the crashed price.
Speaking of price, what about the cost of owning this thing, the expense ratio? Do we know what that will be?
The final number isn't set in stone until after the NFO. It depends on how much money they raise. But we can look at the existing competition and get a really good idea of where SBI will have to land.
Okay, who are the other players?
So Kotak has an index fund version that's aggressively priced at just 0.28%. Tata's index fund is around 0.44%, and Motilal Oswal's ETF is about 0.53%.
So SBI is stepping into a pretty competitive field. they'll have to be sharp on their pricing.
They have to be. In the world of passive investing, cost is one of the very few things that differentiates you. If everyone is tracking the exact same index, why would you pay more for it? I'd expect them to be very competitive.
The fund manager is listed as Viral Chadva, and the fund's mandate is strict. 95 to 100% of the money has to be invested in the stocks of the index.
Right. They can keep up to 5% in cash or government securities, but that's really just for managing day-to-day inflows and outflows.
Just a little liquidity buffer.
Exactly. Standard operating procedure for an ETF.
Okay, now we get to the part everyone is really waiting for. The numbers, the track record. Because you can have the most beautiful philosophy in the world, but if it doesn't make money, nobody cares.
And this is where the greed centers of the brain start to light up.
I'm looking at the historical data for this index, and it is, well, it's aggressive.
That is the right word for it. Now, since the SBI fund is brand new, we have to look at the performance of the index itself and the Tata fund, which has been tracking it for a while now, to get a sense of the history.
Okay, so the sources are citing a 3-year KGR, that's compound annual growth rate, of roughly 31.4%.
Let that number sink in for a second. 31%, compounded, annually.
That doubles your money in, what, just over 2 years?
Yeah, the rule of 72. You divide 72 by the rate of return to see how long it takes to double. 72 divided by 31 is about 2.3 years. It's staggering.
And how does that compare to just buying all the mid-caps?
Well, the parent index, the Nifty Midcap 150, did about 27.4% over the same period.
Which is also an incredible return, by the way. We've been in a strong bull market.
Absolutely. But the momentum strategy squeezed out an extra 4% of alpha on top of an already hot market. And that 4% might not sound like a lot, but compounded over 10 or 20 years, it's the difference between a good retirement and a fantastic one.
But what about over longer periods?
If we look at the backtested 5-year rolling returns, our sources say that the Midcap Momentum Index has outperformed the broad Midcap 150 Index 100% of the time.
100%. That's a statistic that always makes me raise an eyebrow.
Me too! 100% is a very rare thing in finance. But looking at the available data, it holds up. In every 5-year window they could test, the momentum filter added value over just holding the broad index. It suggests that the strategy of cleaning out the junk works pretty consistently over medium to long time frames.
Now, I have a number here that just jumps right off the page. One of our research papers mentions a 1-year return of approximately 76%.
Yes. I was afraid you were going to bring that one up.
We have to. 76% in a single year. That's life-changing money for people.
It is, and here is the giant flashing stop sign I need to hold up for everyone. Context is absolutely everything here. That figure is almost certainly reflecting a specific peak-to-peak period during the massive bull run we saw leading up to early 2026. It highlights the explosive potential, yes. When the strategy works, it sprints. But you have to be so careful not to extrapolate that into the future.
So if I buy this ETF next week, I shouldn't be expecting to make 76% in the next year.
Oh, absolutely not. Please do not expect that. That was an anomaly, likely driven by a massive flood of liquidity into the market. Momentum strategies shine brightest in strong, trending bull markets. But they don't create returns out of thin air. And reversion to the mean is also a law of physics.
Which brings us nicely to the fear section of our conversation. What goes up fast
can come down even faster. The volatility on this index is high. The standard deviation is cited as being around 21.73%.
And how does that compare to something like the Nifty 50?
The Nifty 50 is usually in the 13-15% range. So you are taking on significantly more shake and wobble here. You're not on a cruise ship. You're on a speedboat in a storm.
The official risk rating for this fund is very high.
And it deserves it. You really need to understand the concept of drawdowns. When market sentiment turns, interest rates get hiked unexpectedly, or there's a geopolitical crisis, these high momentum stocks are often the very first ones to get hammered.
Why is that? Why do they fall faster than other stocks?
It's because they're often overvalued by traditional metrics like price-to-earnings ratios. They've been bid up to high prices by that herd behavior we talked about. When the herd gets spooked, they stampede for the exit all at once. So during a crash, momentum strategies can fall much harder and faster than, say, a value strategy. Value stocks have a sort of floor to their valuation that can act as a cushion. Momentum stocks can feel like a bungee cord with no bottom.
So you need a stomach of steel to own this.
You really do. If you're the kind of person who panics and sells when your portfolio is down 20%, you will destroy this strategy for yourself. The whole model relies on you being able to hold on through the gut-wrenching volatility to catch the next upswing.
There's another hidden cost here that we absolutely have to discuss: turnover. This is something that retail investors almost never think about.
And it's the silent killer of returns. I can't stress this enough.
The sources say that the existing Tata fund has a turnover ratio of 190%. Can you explain what that means physically?
Sure. Think about a portfolio that has 50 stocks in it. 100% turnover ratio means that, on average, you've replaced every single stock in your portfolio once over the course of a year.
Correct.
190% turnover means the portfolio is almost completely churning over twice a year.
That is a massive amount of buying and selling.
It's constant. And here's the problem. In India, every time you sell a stock, you pay STT, the security transaction tax. You pay brokerage fees. You pay exchange fees.
And what about impact costs? That's a big one for midcaps, isn't it?
That's the really big one. When a large fund tries to buy a huge chunk of a not-so-liquid midcap stock, its own buying pressure pushes the price up. And when it tries to sell, its own selling pressure pushes the price down. You lose a little bit of value on every single trade. It's called slippage.
So even if the index on paper says it went up 30%, the actual fund in your demat account might only go up, say, 28% because of all these hidden costs.
Exactly. The gap between the theoretical index return and the money that actually lands in your pocket is called the tracking difference. And you can expect the tracking difference to be higher in a high turnover strategy like this than in a simple low turnover Nifty 50 fund where the stocks rarely change.
So that amazing 76% return number, that's the raw index number. The investor always gets the index number minus all these costs.
Correct. And in a high turnover strategy, those costs really compound and create a constant drag on performance. It's a friction you have to be aware of.
Okay, let's look under the hood. What is actually inside this thing right now? Part 5, the sector snapshot.
This is one of the most beautiful parts of a dynamic strategy like this. The fund is sector agnostic. It doesn't care about narratives or stories. It only cares about price action.
Give us an example of how that plays out.
Well, if we were having this conversation back in 2021, this fund would have been absolutely stuffed with IT stocks.
Tech was on fire then.
Exactly. Companies like Wipro, Mindtree, they would have been top holdings because that's where the momentum was.
And what about today?
Today, the algorithm has completely rotated. Based on the most recent data, the portfolio is heavily weighted towards financial services. That's about 30% of the fund.
Okay.
And healthcare is the next biggest at around 12 to 13%.
So it automatically dumped the tech stocks when they cooled off and bought into the banks and pharma companies when they started to heat up.
Automatically, without you having to do anything. You didn't have to predict that 2025 would be the year of the banking boom. The momentum score saw the prices moving, and it just adjusted the portfolio for you.
Who are some of the big names in the portfolio right now? The captains of the team.
Well, we're seeing stocks like BSE Ltd.
The stock exchange itself.
It's stock of the stock exchange, yeah. It's doing well because the market is doing well. It's very meta.
I like that. Investing in the casino while you're playing in the casino.
Pretty much. We're also seeing names like Hiromoto Corp, Muthoot Finance, AU Small Finance Bank.
So that's a diverse group of businesses. You've got two-wheelers, gold loans, a small finance bank.
And remember that 5% cap we talked about? So even though a stock like Max Financial Services is a top holding, it's capped at around 4.94%. It's not allowed to take over the whole fund.
It's a team sport, not a one-man show.
Exactly.
Okay, so we've unpacked the engine, the philosophy, the massive risks, and the current portfolio. Now we get to the million-dollar question, or I guess the 5,000 rupee question. Who is this for?
This is definitely not for everyone. I cannot stress that enough.
Let's do a quick checklist for people listening.
Okay. First, if you are a conservative investor, if you lose sleep at night when your portfolio drops 2% in a single day, please stay away. This is not for you.
If you're the kind of person who checks their portfolio app every hour,
this fund will give you an ulcer. Don't do it.
What about time horizon? If you need this money for a wedding next year or a house down payment in 2 years,
absolutely not. Do not touch this. This is a 5-year plus game minimum. You need that long time horizon to be able to ride out the inevitable volatility. If the market crashes tomorrow, you need to have the financial and emotional capacity to wait 2 or 3 years for it to recover.
Okay, so who is it for then?
It's for the investor who already has their core portfolio sorted out. You know, they have their Nifty 50 index fund, maybe some PPF, some gold, some debt funds, the boring, stable stuff that pays the bills.
Right. And now they want to add a satellite to that core. They want to take maybe 10 or 15% of their total portfolio and chase alpha. They want to try and beat the market. So this is the high risk, high reward part of your money.
Exactly. It's for the aggressive investor who understands that volatility is the price you pay for admission to the theater of higher returns.
And what about the actual vehicle? SBI is offering this as an ETF. We know that Tata and Kotak offer it as an index fund.
Yeah.
Is one better than the other? This is a common point of confusion.
It really depends on your personal style and needs.
Break it down for us.
Okay. The ETF, which is what SBI and Motel are offering, is great if you already have a demat account and you like the idea of being able to trade instantly during the day. ETFs also often have a slightly lower expense ratio, but there's a potential catch.
Which is?
Liquidity. Sometimes, with ETFs that track less traded stocks like some midcaps, the price you see on the screen, the market price, can drift a little bit away from the actual underlying value of the stocks, the NAV.
Ah, the fair value problem.
Right. You might end up buying at a small premium, say paying 10.50 for what's actually 10.0 of value, or selling at a discount if there isn't enough trading volume at that moment.
Okay, and the alternative?
The index fund, which is what Tata and Kotak offer. There, you buy and sell directly from the mutual fund company. You're guaranteed to get the end-of-day NAV. It's the guaranteed fair price. And you don't need a demat account for it.
So the index fund is simpler, more of a set-it-and-forget-it option.
Yeah.
The ETF is for the more active trader who wants that intraday control.
That's a great way to put it. If you're doing a long-term SIP every month, an index fund is often less hassle. But if you want to try and time your entry during a market dip in the middle of the day, the ETF is the tool for that job.
Got it.
And one more thing on this specific SBI launch. Since it is an NFO, there is no track record for this particular scheme. You are betting on SBI's ability to execute the strategy well and track the index tightly.
But they're SBI.
Right. SBI is the largest fund house in the country. They have the systems, they have the scale. It's a pretty safe bet that they know how to track an index properly.
Okay, let's bring it all home. Let's try to synthesize all of this. What does it all mean?
It means we now have another tool available that essentially automates greed.
Automates greed. I like that.
I mean that in the best possible way. It automates the very difficult strategy of cutting your losers and writing your winners. It takes your ego out of the equation. It removes your hesitation. It forces you to sell what's not working and buy more of what is.
So it's high-octane fuel for your portfolio. It's great for speed, but it's very dangerous if you don't know how to handle the machine.
That is the perfect analogy.
I want to leave our listeners with one final provocative thought to chew on. You mentioned earlier that momentum works because we humans are irrational. We underreact, and then we herd. We get FOMO.
Right. It's a behavioral anomaly that the algorithm exploits.
But we are rapidly moving into a world that's dominated by AI, by algorithmic trading, by machines just like this very index we've been discussing.
I see where you're going with this.
If, say, 80% of the market becomes automated, if algorithms react instantly to earnings news, does that underreaction phase disappear? Does the herding happen in milliseconds instead of over months?
That is the existential question for this entire factor. If everyone becomes a momentum investor, does momentum stop working? Or does it just create faster, more violent cycles?
Maybe the 6-month trend becomes a 6-minute trend.
It's possible, but I think as long as there are still humans pushing the buttons or humans panic selling when the algorithms cause a dip, that behavioral edge will probably remain in some form, but it might get sharper. The swings might get even wilder.
Something to mull over the next time you're checking your portfolio.
Indeed.
So if you're interested, the SBI Nifty Midcap 150 Momentum 50 ETF NFO is open until Tuesday, February 24, 2026. As always, check the prospectus, read the risk documents. It says very high risk, right on the label for a reason, and decide if you want to add a little bit of momentum to your life.
And just remember Newton's law. An object in motion stays in motion until it doesn't.
A perfect place to end. Thanks for the deep dive.
Anytime.